Hi there, welcome to Kneppy Invest. Very exciting here because we're into the top 20. For those who haven't seen previous videos in this series, I am going through those companies on the ASX that have performed the best since 2013 using some criteria, and I'll talk about those criteria in the next few slides. Now, I've already gone through those companies that came in between 30 and 21 in previous videos. Also looked at some honorable mentions, some of those worst performing companies as well. And in today's video, we'll be looking at 5 companies that came in between 20 and 16. A few surprises there, a few companies I have never looked at before, and also a few companies that I'm not shocked that are in this list. Now, before we have a look at these 5 companies, I just have to mention some very important points, some of the criteria I did use, and also we'll look at 5 companies that performed pretty poorly over the past 10 years. Now, before we get into the list, these are very important points. This is not my opinion. These are not companies that I consider to be the best 20 companies or 30 companies on the ASX. In fact, as I mentioned, 2 of these companies I have never looked at before in the past. So this is not my opinion. This is based off total analyzed returns. So if you held these 30 companies in your portfolio over the past 10 years, your overall returns probably would have been well over 20%, probably, or might have been even closer to 30%. So this is just based off total analyzed return. So if you don't know what that means, it's just share price appreciation plus dividends. Some of these companies are dividend paying companies. I use Guru Focus, one of their screeners, and I don't completely trust Guru Focus because at times when I do look at or see some of the numbers they spit out, I test it, and sometimes it is a little bit wrong. So I don't always trust these financial platforms like Guru Focus. Only companies that have been listed since 2013. So you won't see WiseTech on this list because WiseTech listed 2015 or 16. And if I do another video on the best performing companies since 2018, WiseTech would be near the top of that particular list. The other criteria I did use is I excluded non-mining companies. Now, this might be a little bit controversial when I go through the list of companies between 15 and 11, because there is a mining company in that. So I did spend a little bit of time wondering if I should exclude that company. And that will become obvious when I talk about that company. And I'll also exclude companies that are not or have not generated any revenue. In fact, one of the companies that would have been near the top of this list, a company actually I own in my portfolio, New Ren Pharmaceuticals, they have just started receiving a little bit of revenue because one of their products, the only product really at this point in time, has just received FDA approval, and they do have a relationship with Arcadia, who will be selling that product. I think they've already started selling that product in the United States. So non-mining, only non-mining, revenue-generating companies within this list of 30. And I only included companies that had a market cap above $1 billion as of the 31st of May, 2023. And honestly, when I did do another list looking at those companies that performed really well over the past 10 years with a market cap of below $1 billion, there weren't many. Because if a company has performed really well over the past 10 years, more than likely their market cap is already above $1 billion. And the final point is perhaps the most important point. Just because these companies have performed brilliantly over the past 10 years doesn't necessarily mean they will perform really good over the next 10 years. And the whole reason why share price of companies will increase over time is because of financial expansion plus multiple expansion. And quite a few of these companies have seen the share price increase mostly because of multiple expansion. We have seen some financial expansion, profits increasing, but the market right now is more willing to pay a premium for some of these companies. And in my previous videos, I use the example of Microsoft. If you break down Microsoft performance over the past 20 years, you'll see a period between 2003 and 2013, you wouldn't have performed really well because the share price of that company went sideways. But between 2013 and 2023, you would have seen significant returns in Microsoft because share price has completely taken off. But during 2003 and 2013, Microsoft was growing financially. The only reason the share price went nowhere was because that was a period of multiple contraction. The P/E ratio of that company was going down. Now the company is seeing a little bit of multiple expansion. So you have financial expansion, multiple expansion, and that's why you would have done really well owning Microsoft over the past 10 years. So it's very important that even though a company could still grow financially, the share price might go sideways or even down because the market might be less willing to pay a premium for that company. Before we have a look at the really good performers on the ASX since 2013, let's look at some of the worst performers. And to be honest with you, it's not a surprise that some of these companies are on the list. Maybe only one. I'm a little bit surprised Nufarm is here. But the majority of these companies, if not all these companies, I would consider low quality companies. Just look at the return on invested capital. The return on invested capital for all these companies is less than 6. And return on invested capital, in my opinion, is one of the most important metrics. You want to see a company giving their shareholders a good return on invested capital. I typically look for a number greater than 10. For all these companies, it's less than 6. Not only that, revenue growth has been absolutely mediocre for all these companies. And that's another thing I look for, is really good revenue per share growth. In fact, 3 of these companies have seen negative revenue per share growth over the past 10 years. And obviously, earnings per share growth has been quite bad, but positive for all companies apart from Air New Zealand, which is negative because they had no profit in the past year. And dividend growth has been fairly mediocre for a few of these companies, apart from Horizon, which is 12.2%. And the 10-year analyzed return for these 5 companies is between about 3.5 and 3%. That's pretty mediocre returns over a 10-year period, just barely beating inflation. Coming in at 20, we have Macquarie Group. Now, I was a little bit surprised it was not a little bit higher, but with analyzed total returns of 20.1% per year, you would not complain if you had this company in your portfolio over the past 10 years. I will complain because back in 2013, I actually owned Macquarie Group and then I sold it. I don't know why I sold it, because this is definitely the sort of company that you can hold in your portfolio and not have any qualms about it. Now, probably the only red flag I would say about Macquarie Group is revenue growth. So revenue per share growth of only 4.6% per year. The company's margins have increased quite well over the past 10 years. And that's why they've converted that pretty mediocre revenue growth into earnings per share growth of 15.2% per year. So my only question in regards to Macquarie Group is if they can continue going down that margin or increasing margin path they have seen over the past 10 years. And if they can't, the lack of revenue growth is a little bit of a concern. Nice dividend growth of 11.8%, return on equity at 13.7%. Now, in Guru Focus, this company had no return on invested capital. That's probably a reason behind that. But a return on equity of 13.7 is in the good side. So I want to see a return on equity at least above 10. And that return on invested capital, I should mention, is the 10-year. What was it? 10 year? It wasn't the mean, it was the median. So 10-year median, a return on equity for Macquarie Group is 13.7. So that's definitely on the good side. You want to see that definitely above 10. Now onto Macquarie Group's chart, and this is the weekly chart over the past 10 years. And this is exactly what you should see for these top performing companies. Share price going from the bottom left to the top right. Now, the path the company's share price takes to get from the bottom left to top right is a little bit different, subtly different for each company. In fact, for some companies, it's completely different. And we'll see that definitely with one company later in this video. But this is exactly what you should see for high quality companies. Now, I do like this chart. It's a nice, steady climb with the share price. On occasion, you will see the share price dip, like we saw during the COVID-19 financial panic. We also saw it during 2016. That was a nice little sort of buy-in dip, and possibly we're seeing it now. But the one thing I did notice is that blue line, that solid blue line, which is a 150-week moving average. Very rarely does the share price of Macquarie Group fall below that. Very briefly in 2016, for a period of time during the COVID-19 panic in 2020, and for a very brief period of time in June of last year. And right now, Macquarie Group's share price is just above that 150-week moving average. So just based off that, now might be a good time to think about taking a position in this company if you are bullish on Macquarie Group. Coming in at 19 is a company I know nothing about, Infratil. The only thing I know about Infratil is that it's an infrastructure play. It's been around on the ASX for about 12 or 13 years. Now, when you look at the chart, you'll notice if you go back to, say, 2013 through to about 2017, 18, no one on the ASX had heard of this company. Very liquidly traded. The liquidity has really improved over the past 3 or 4 years. Another thing the only thing I know about Infratil is it does have a bit of a play in the data center area, but that's probably all I know. And the only reason I know that is because Infratil was mentioned on Ausbiz The Call the other day. And when it came up, when its name popped up, I started to listen. But when you look at some of these numbers, it is interesting. So negative revenue growth. Now, that might not be a problem because they're in infrastructure play. Possibly they have sold off some assets, which is why they have negative revenue growth. Earnings per share growth, 28.1%. That's quite good. Dividend growth, 8.1. Return on invested capital, 2.3. I'm not sure you can actually look at return on invested capital for these type of companies, but analyzed total return of 21% per year. So they are doing something right. Now, I'd probably have to do a little bit more research to understand why the revenue growth is negative 11% per year. There's definitely some reason behind that. And if you look at the chart, not only is this chart a weekly chart, I can take it back all the way to when they're listed on the ASX in 2010. And in the first 6 years of this company's life on the ASX, it was quite illiquidly traded, but the share price did actually increase. And you know it's illiquidly traded because there's hardly any volume, and you can just see the share price doing absolutely nothing, going sideways, and all of a sudden there's a massive jump. There's no really long candlesticks, that sort of thing, like you're starting to seeing right now. And the volume of this company really exploded in the second half of 2020. You can just see a massive increase in volume during that period. Not sure why, but this is a really nice looking chart, bottom left to top right, just like every company on this list. But the share price just keeps on going higher. On occasion, you'll see a fairly short-term downtrend in the share price, say maybe a 4 to 8 week downtrend, but that's about it. Share price has remained above the 150-week moving average throughout its whole time on the ASX, apart from 1 week in March 2020, when the ASX had its low. When it got down to, was it 4,600 or something? That was low in Infratil's share price when it was about $3.20. Current share price is around about $9 and near its all-time high, just a few weeks off its all-time high. So everything going really good just based off this chart for Infratil, but I know nothing about their financials. Know nothing about why revenue growth is decreasing. And to be honest with you, have never been all that interested in infrastructure companies. So I mentioned that I did own Macquarie Group. I think I mentioned this back in 2013, and for some stupid reason I sold it maybe 5 years later. And Macquarie Group spun off, I think it was Sydney Airport, and I probably should have held on to Sydney Airport shares because the share price of that company went up. But I'm not an infrastructure type investor, and as soon as I got my Sydney Airport shares, I almost immediately sold them. So maybe that's one of the reasons why I've done no research on Infratil, but whatever they're doing seems to be working. Coming in at 18 is another quasi cult stock on the ASX. This is definitely a favorite among fund managers. In fact, whenever I hear an expert speak, about their favorite health companies on the ASX, ResMed is always mentioned, almost always mentioned, and for good reason. This is a quality company, and it's a little bit surprising that I have never held this company. Revenue growth, 12.2% per year. That should be revenue per share growth. Earnings per share growth, 13.1%. Dividend growth, 14.9%. Return on invested capital, just under 20%. And analyzed total returns of 21.2%. So this is definitely the sort of company you just buy and hold in your portfolio for the long term. And as we look at ResMed's weekly chart over the past 10 years, this is absolutely brilliant chart. Very rarely you do see the share price pull back. In fact, it's very hard to see the COVID-19 financial panic. We saw a little bit of a dip, a 1 week dip, and then the share price almost immediately bounced back. And what's been really interesting over the past year or so is that the 150-week moving average, which is that solid blue line, has acted as support during that time period. In fact, it's acted as support on about 10 different occasions. You can just see the share price just ride that moving average during that period. And the share price is just above that moving average right now. And if you do believe this is a high quality company that will continue to grow at really nice rates over the next 10 years, this little bit of weakness in the share price that we have seen over the past 2 years, share price did get to $40 in September of 2021. So the weakness in the share price, right now it's $32, might be an opportunity for you to buy into this high quality company. And maybe I'm even talking to myself right now because I've never held this company. And now might be the time to think about buying into ResMed. Coming in at 17 is Hansen Technologies. I was a little bit surprised to see this company on the list. And you'll understand why I was a little bit surprised when we look at the chart. I am or have been a shareholder of this company, and I'm no longer a shareholder. I've decided just to take profits because there were some things I didn't like about this company. Now, revenue growth 14.1% per year, earnings per share growth at 13.3. You'll notice the markup here is 653.6, but that's in US dollars. If you do the exchange rate, the markup of this company is just above $1 billion. But nice revenue growth, nice earnings per share growth, dividend growth 2.2, return on invested capital 9.1. I would prefer that to be a little bit higher. So that was one of my red flags, probably not a red flag, an amber flag against Hansen, but really nice analyzed returns, 21.2% per year. But when you look at the chart for this company, it is quite a bit different from those other companies. And that will become clear when we look at it. So let's have a look at it right now. So even though in terms of the share price moving from the bottom left to the top right, the path Hansen Technologies has taken is quite a bit different from the other companies on this list. And the majority of those companies have seen the share price remain above the 150-week moving average for a large portion of that 10-year time period. You can't say that's true for Hansen Technologies. In fact, between 2016 and 2021, the share price of Hansen Technologies actually went down. And for a large period of time, the share price of the company was below the 150-week moving average. So what I'm seeing here with Hansen Technologies is there's a time and place, maybe not place, there is a time to hold this company. And that time for this company was between 2013 and 2016, when the share price went from $1 to $4.50. And the next time was from late in 2020 through to late in 2021. So 1 year period where the share price went from about $3 to $6.60. But since that high in late 2021, the share price has really been struggling. In fact, the pattern I'm seeing on the chart is fairly similar to the pattern we saw between 2016 and 2020, where the share price did absolutely nothing. So you want to hold this company for maybe the medium term, maybe when the share price is in the uptrend, because I can definitely see periods of time where the share price of this company might do nothing. And I think what's happening here is the market gets a little bit overexcited about this company, like maybe it did in 2016. And the PE ratio for this company gets a little bit too high. And then to catch up, the company keeps on growing their profit, that sort of thing. But then we see a period of multiple contraction where the PE ratio falls lower. And I think that's probably what we happened for that 40-year period between 2016 and 2020. And perhaps that's what we are seeing now. The share price is really doing nothing, multiple contraction, and hopefully the company keeps on growing. So if we see the PE ratio get down to attractive levels, maybe that's a time to think about taking a position in this company. Coming in at number 16 is a company I know very little about. I will be doing a Kneppy's analysis video on this company in the next month or so. And it was really exciting because I was listening to an Ausbiz The Core episode a few weeks ago, and Macquarie Technology Group did pop up. And because I knew I was doing an episode on this company, a video on this company, and I knew this company was going to be in this particular list, I did pay attention. And it was really good because in that video with Mark Morland of Team Invest, he was an ex-shareholder of this company. He actually did say he was very happy that he did sell out of this company because financially, this company has really not performed over the past few years. And that really shows up in the numbers right here. So just like Hansen Technologies, markup of this company is just above $1 billion. Revenue growth 3.9% per year. revenue per share growth. So I think they probably have done some capital raisings. I think they've gone through a pretty big capital raising recently. Earnings per share growth, negative 3.2%. Now, they haven't issued a dividend over the past few years, so a dividend growth is not applicable. Return on invested capital, 6.9. But because this company is sort of like a quasi-infrastructure company, and even though I don't know much about this company, I do know they are spending a bit of money on data centers, that sort of thing. And I'm not a big fan of data centers, just like infrastructure companies. In fact, I would say data centers are like a quasi-infrastructure company. So maybe that's one of the reasons I've never done any research on this company, is because I just don't like what they do. So I'm willing to ignore the return on invested capital 6.9 just because of they are a quasi-infrastructure company, but really good analyzed total return, 23.5% per year. So why is there a disconnect between the financials and that analyzed total return? And this sort of was discussed in that AusBiz the call. And the other guest, the one other than Mark Morland, just mentioned, if I remember correctly, that the market expects significant growth, maybe because of the data centers, in the next 5 to 10 years. And if the company doesn't show that significant revenue, earnings per share growth, the share price of this company will be absolutely punished. And the chart for Macquarie Technology Group is absolutely fascinating. So between about 2015 and 2021, the share price of this company went from $7.50 all the way up to $82.50. So a beautiful chart for those shareholders. And just like many other companies on this list, the 150-week moving average was sort of the support level. In fact, during the COVID-19 financial panic, Macquarie Group, Technology Group share price fell to $20, and that was right, and it bumped off or jumped off the 150-week moving average. But we have seen a fair bit of weakness in the share price over the past 3 or 2 years. So the share price did get to a high in September 2021. That high was $82.50, and the share price did pull back. It does look like it moved into a downtrend, and the share price is hovering right around that 150-week moving average, and it's hovered around that level or that moving average for about 9 or so months. And right now, it's just above that moving average. So it's really interesting to see how the market just fell in love with this company just after COVID-19 financial panic. Share price quadrupled in a fairly short period of time. And I think just the lack of financial growth is my main question about this company. And that's all I have for this video, looking at those companies that came in between 20 and 16 on the best performed ASX companies since 2013. There's a few surprises here, a few companies I have never done any research in the past, Infratil and Macquarie Technology Group. A few companies I was not surprised to be on this list. In fact, I might have been expecting ResMed to be a little bit higher, but not surprised Macquarie's there. ResMed was on this list. Hansen Technologies, wasn't really thinking that company would make it onto this list, but in the end, it has performed quite well over certain short or medium-term time periods. And right now, it's in a bit of a lull. Share price really not doing anything over the past few years. So if you have any questions, any thoughts about these 5 companies or those 5 worst performing companies, love to hear your thoughts. So leave your thoughts, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.